This week, the Bank of Canada will be delivering its latest rate decision. It comes at a time of concerns about the impact of tariffs, slowing economic growth, and the future path of inflation. Joining us now to discuss what to expect is Chris Whelan, Senior Canada Rate Strategist and Head of Portfolio Strategy with TD Securities. Chris, welcome back to the program.
Thank you. Thanks for having me.
All right, so these rate decisions are always in focus. People wondering what the bank is going to do next. What is the call? What do we think they're going to do this Wednesday?
I would think they're going to hold this Wednesday. I think in North America you're in this lull right now for cuts. We're kind of sitting and waiting. You got the tariff and trade war uncertainty. You have economies that they take a while to roll over. I think we always kind of assume the economy is going to roll over sooner than it is, and I think sometimes economies can carry on for longer than people expect. I think humans are quite resilient at keeping it going. So for now, the data hasn't been too bad. You got a little bit of concern with the 3-month core inflation. So when you kind of average things out and take a less way, the overall inflation number can be tilted one way or the other. You try to take the biases out with core, which the bank likes to do smartly. So you look at 3-month core inflation, it's above 3% right now. So you're like closer to 3.4. I think that gives pause for that gives some concerns and pause there. Are we worried that leads to hikes so soon and we just do a 180? No, we're not worried about that at all. We just need to see some weaker data and then inflation take a bit of a breather, which we think it will come in the back half of the year. But for now, we wait. We wait. It's not uncommon for the Bank of Canada to cut or even hike and pause and hike, cut, pause and cut. So I think that's where we're at. I think it's kind of a similar backdrop in the U.S. as well.
Yeah, we had 7 consecutive meetings of cuts, and then the pause hit in the spring. The call is for another pause for this month. When do they come off the sidelines? And I'm assuming the call is cuts and not hikes. So when do they come off the sidelines and start cutting again?
So I think we'll see in the data. We think they're going to end up around 2% within the coming 8 months or so. So 3 cuts from here, 325 bips cuts from here. So I think they can probably resume even as early as the next possible meeting. Time will tell. So I think we just it's really keeping an eye on that 3-month core inflation number, seeing that it would be nice to see that dip back down, come below 3. It would be nice to see. It's not nice, but we would be helpful to see some more moderate growth on the GDP side. So these are some of the things we kind of need to see come into play. So time will tell, but I think in the end of the day, we think we're going to 2% on the overnight rate for now.
If we get those 3 more quarter-point cuts, we end up at 2%. You said in 8 months or so, roughly in that timeline. Is that a place where the Bank of Canada can sort of just stay and say, we're comfortable here, or is it really dependent on, I guess, the impact that we're going to see on the economy from all this uncertainty?
I guess it's funny in this industry we always like to put a finite number on something. I think.
Where do we finish here? Right?
Where do we finish? What is the final answer? I think it's always a fluid process. So I think let's see where we sit. But I think in the end of the day, it's hard enough to forecast the next 2 or 3 months. So how we forecast beyond 12 months, we do our best, and sometimes we're pretty good at it, and sometimes you're not. But I think for now, I think we end up probably somewhere around 2. The consensus is 225. To 225, so we're only a touch below that, just on we think the uncertainty risks, and we think some of the poor surveys we've seen in Canada will, in the end of the day, translate to some growth hits. So we sit just a little bit more dovish than the street at 2% versus 225. And I think that's a reasonable spot for them to sit and adjust and reflect on where we're at. I think the things to keep in mind are the housing market, how weak it is. We'll see how that translates. I think that's more a 12-month out sort of thing, and I think that kind of broadly comes into our overall view of the economy slowing overall. In big cities, sales are extremely low right now, but I think then that kind of just gives us. That's not necessarily an additional dovish point. It just kind of gives us confidence that in our call that the economy will gradually weaken, and we'll see a move down to 2%.
You talk about the resilience of the economy, the resilience of humans who want to keep on spending and having a good time, go on vacation.
Of course.
But you mentioned the housing market, you mentioned some other surveys and stuff like that. Are we starting to see the tariffs seep their way into the economy? I think that's been a head scratcher for some people. I thought, well, April, big tariff announcement, here we are in June, why aren't we seeing the impacts?
I think it takes time to see the impacts. So I think it's just a matter of wait and see. I think a couple weeks ago we were starting to see positive signs on the trade front, and maybe this was going to resolve okay. There's other theories out there that this is not going to resolve okay. So I think it's an incredibly difficult time to have a lot of confidence. I think the first half of this year was kind of stay the path, don't do anything crazy, but also don't react too much. I think the back half of the year we're going to get some more clarity, where I think people can start reacting and making changes in their portfolio if that's what they think.
All right, so if we're talking about more clarity in the second half of the year and maybe a path forward, again, we don't have a crystal ball, but what would that actually mean from an investment perspective?
I think from an investment perspective, I think if we take a look at U.S. yields, you got the U.S. 30-year around 5%. That's a big number. If you have some clarity that inflation isn't going to be on a runaway, and that growth is rolling over or fairly modest, then that's going to prove to be an exceptional buying opportunity, which we're quite constructive on U.S. yields moving lower from current levels. So I think you have setups where you can have big returns in 30-year bonds. I think a lot of times people think the big returns are in stocks, but I think you can have pretty big returns in bonds if you're using 30-year bonds or the long end of the curve. It can move a lot. It's pretty volatile. So there's some opportunities there, and I think bonds will protect you. I think bonds will protect stock portfolios on risks in the future. So I think there might be some opportunities to move back to bonds when you're looking at 5% type yields. Give or take, we're a little bit lower in Canada, but you add corporate bond spreads in there, you're in the 4 to 6% range on yields. These are decent yields for a lot of investors, especially conservative ones. So you can, I think, over the next couple of years, the longer we stay here, I think the longer you can change behaviors and have a move back towards bonds, away from stocks, or at least a move towards protecting again. We kind of have this thing, the 60-40 portfolio in the industry.
Question that, everything we've been through, right?
Then everyone kind of said, oh, we got to move to 70-30 or 80-20 or 60-40 is dead. I think the 60-40 has a lot of credibility on a go-forward basis. So I think that's probably kind of the conversations, or depending on what investors' needs and the work they do on their own and with their advisors. I think that those are things that people would be looking at into the end of the year. But I think it's more so getting the clarity to have confidence in bonds.